going on, everybody? I'm Alex Quin, and you're listening to the Hustle Inspires Hustle podcast. Today, I'm very excited because you guys know I'm a book nerd, and every time I read a book that brings me immense value, I want to run and interview the authors. We had a ton of amazing authors on here so far over the last few years, and to start 2024, it is an absolute honor to have Tom Wheelwright, entrepreneur, CPA, and author of Tax-Free Wealth on our podcast. Welcome, Tom.
Thanks, Alex. Really a pleasure to be here with you.
Absolutely. I appreciate your time. And I want to tell you, man, so much value in your books. Like I told you a few minutes ago, I found out about you through one of my mentors, and I'm so glad that I did. Thank you for jumping on the podcast, man. How are you today? How's your new year starting off?
New Year's awesome. It starts by hearing from people like you that read Tax-Free Wealth and it's made an impact. So that's what's most important.
Yeah, I nerded out on Tax-Free Wealth. I took notes. So I have like a Google Doc full of notes from the book and things that were important to me. So I want to unpack that today. But before unpacking the book and all that, we want to get to know a little bit about you. If you could give us your elevator pitch on who's Tom and how did Tom get to where he is today, and then we'll jump into the book and everything else.
Yeah, sure. So I grew up in Salt Lake City, Utah. So I grew up a Mormon boy and got to spend 2 years in France learning how to get rejected in French. And seriously, if you can sell religion, you can sell anything. So that was really the start of my entrepreneurship, was being a Mormon missionary. And then I spent, after my school and graduate school in tax, I went to Ernst Young and was in there. I was at Ernst Young for 7 years, including 3 years in the National Tax Office in Washington, D.C. And I spent 4 years with a Fortune 1000 company as their in-house tax advisor. And along the way after that, I started my own CPA firm. I taught for 14 years in the Masters of Tax program at Arizona State University. And about 20 some odd years ago, I met a fellow by the name of Robert Kiyosaki, Rich Dad, Poor Dad. He actually became a client, and we have traveled around the world, and we have so much demand for people like me that we decided to start a franchise. So now we have our Wealth Ability franchise, which is really, the goal is good or bad, basically tax nerds like me, teaching people how to reduce their taxes.
Yeah, I love it. When I first started my business, I'll be quite honest, I didn't look into a lot of this stuff. When I grabbed your book, I was like, oh my God, there's this whole other world that you need to understand as a business owner. And if you don't want to understand it, at least you need to affiliate yourself or hire somebody within a network that knows what they're talking about. Tom, let me ask you, did you always know you were going to like numbers? Was a high school Tom like aware of this, or how did this happen?
I grew up in a family business. My dad was a printer, and he was partners with his uncle. They did high quality color lithography, and we all worked in the business, and I worked in the bookkeeping department. I was a bookkeeper in the accounting department. My mother was the controller. And so numbers came easy to me since I was little, and I like law, and it's a really nice combination of numbers and law.
So it's safe to say your parents were a big influence on like what you are today, who you are today as a professional.
Oh, for sure. My mother, the biggest, because she taught me that to any problem we have, there's probably 50,000 answers, and we've probably only identified 3 of them. So she was very expansive in her viewpoint of the world, and a huge influence on how I think.
From that time to the time you became an author at first, how much time passed, or when was your first publication?
So I first published Tax-Free Wealth in 2012. So I was not a young buck. So I would have been what, 55?
Okay.
When I wrote Tax-Free Wealth, and we published Tax-Free Wealth. So a long time. I'd had a lot of years in the industry before I wrote down what I thought was really going on in the industry.
How long did it take you, like from start to finish?
About a month.
Oh my goodness, a month?
Well, again, I'd been doing this for my whole life, right? So it was just putting my thoughts down on paper. Of course, then the editing and everything takes longer than that. But the initial draft was done in a month.
It's I ask you because I I launched a marketing book last year. I launched a children's book, which was more of a passion project a few months back. And I just finished the first draft of my full scale marketing book. I'm a digital marketer. That's what I do. I run
Mhm.
ads for people. So I did a whole entire framework of how to do digital marketing, and it's been quite a lot of work. So my respects to you on your book and everything that you've done. I know that's that's a whole lot of work. So tax-free wealth obviously talks about taxes. Can you start telling us what tax-free wealth is all about? What made you write this new version? How old is the new version?
So the new version is brand new. So
Okay.
this is the third edition. It actually is just launching right now. So this is the third time. So this is it looks like it's about every 6 years. So the
Mhm.
last one was after the 2017 tax law. That was a major tax revision. And then this year, we just had so many tax revisions since COVID started, really about 5 or 6 major revisions to the tax law in the last 6 years. So I felt like I really had to kind of consolidate everything from the second edition and then add in the new stuff for the third edition. So that's why I did that. But tax-free wealth is really all about changing your mindset about taxes. It's the idea is that taxes are out there to get us, that they're trying to just steal our money from us, and the fact is they are stealing the money from us, but probably because we don't understand it, not because it's inevitable. I always
Right.
say the two things that are inevitable are death and taxes. And I would say taxes definitely are not inevitable. And that's what tax-free wealth is about. I hang out with a lot of people that don't think death is inevitable. So that's going to be an interesting frontier going in the next 10 years.
I hear you. So listen, in your book, I'm gonna quote you: taxes will either make you rich or make you poor. The tax laws of all countries are written to encourage certain activities that benefit the economy and promote social policy. It is our job to understand and take advantage of the tax laws as they are written. So in other words, a lot of people may see it as a burden, but some other people see it as an opportunity. Can we unpack that?
Yeah. So think of it this way. So the first time you ever got a paycheck, you probably didn't think of it this way, but you realized pretty quick that all the money you earned wasn't yours and that you had a partner in that job, and that partner's the government.
Mhm.
And what we really have is we have a choice. We have a choice between being a silent partner or an active partner with the government. And tax-free wealth is just saying, well, look, here are the things. And then my subsequent book, The Win-Win Wealth Strategy, here are the things that the government wants you to do. And if you do those things, we're actually going to incentivize you to do those things, and we'll actually pay you to do those things. So we'll literally pay you for investing in business. When you start a business, the government will pay you to start a business because the tax benefits of starting the business are greater than the cost of starting a business. I mean, you're an online marketer, so starting an online marketing business is not an expensive proposition. And the reality is that it's so low that the tax benefits from starting the business are actually pay for the business to start up. So the government just wants us to do certain things, whether it's create housing for other people, whether it's to create energy through either fossil fuels or renewable energy. There are tax incentives. Anything you can think of that the government wants us to do, there's probably a tax incentive for it.
Okay. Now, as far as taxes, because to the untrained ear, to somebody who's not really into this, they say, okay, I pay my taxes through my paycheck, or I pay taxes at the store when I pay gas. But there's a lot of taxes, Tom.
Yeah.
Help me break them down. We have state tax, income tax, federal tax, estate tax, which is also death tax. What else do we have?
You have gasoline tax, you have excise taxes, you have sales tax, you have property tax, you have luxury tax. I mean, there's like 20 to 30 different taxes. If you're in Europe, you have value added tax. So there's travel tax, there's hospitality tax. When you travel, you pay tax on your hotel room. There's a myriad of taxes. It's enormous. Just income tax for somebody who earns a good salary, it takes you about 4 months of working for the federal government during the year before you ever get to working for yourself.
I'm glad that you bring that up, Tom, because I want to quote you again. The average person from your book, Tax Free Wealth, the average person in a developed country spends 25 to 35% of their life working to pay taxes. That means more than 2 hours of every workday are dedicated to feeding the government. And 3 to 4 months out of the year are spent working solely so that you could pay taxes. That adds up to over 13 years of work in your life, uh, and 13 to 20 years in your lifetime. That's a prison sentence.
There you go. To me, it's like, well, why are you spending all this time if you had a choice, right? The problem is that it used to be that taxes were only on the excess money of the very, very rich. But over the years, what's happened is the government's gotten greedier and greedier, and they want more and more money. Well, where's the money? The money's in the workers. The money's not in the wealthy. That's not where all the money is. I mean, really, all the money is in the economy and the daily worker. And so they keep going after the workers and employees. You're a W-2 employee. I mean, there are a few things you can do to reduce your taxes, but unless you're a business owner or a serious investor, you're going to pay a lot higher taxes than really the rest of the people are going to pay.
Gotcha. So we're talking about saving. So what are some simple yet smart ways entrepreneurs or investors can pay less taxes without breaking any rules?
Well, first thing is, and this is important. Thank you bringing that up for tax-free wealth, because we're not talking about breaking any rules, tax-free wealth.
Yeah.
Okay. It's very important to legally, morally and ethically. But the first thing to do is change your mindset about it, because once you realize that we need to change the questions we ask, because typically I get the question asked. So like somebody will buy a mug here, like this one, and they'll go, "Oh, sorry, here you go." So here's a mug. Is this deductible? That's the question, right? And what we need to do is ask better questions, like, how do I make that mug deductible? Not is it deductible? Because I mentioned this in the book. If you really want to change your tax, you have to change your facts. So that means that anything can be deductible. The trip you take to Hawaii can be deductible. The meals you take your wife to dinner, it can be deductible. You buy a new car, that can be deductible. So anything can be deductible. The question is, what do I have to do to make it deductible? And am I willing to do those things to make it deductible? So that's the most important message in tax-free wealth, actually, is that you can change your facts if you want to. But the most important thing is you have a choice. So I may choose to go to Hawaii and not do any business while I'm there and pay tax on the income that I used to pay for the trip to Hawaii. Or I may choose to go and do business while I'm there and not pay tax on the money I used to travel to Hawaii. But that's my choice. But unless we have the education, we have no choice.
Yeah, you just can't assume, oh, I'm going to go around and write this off and write this off. Like, there has to be a purpose. There has to be a plan. It has to be by the book. You're going to go to Hawaii with your wife. Great. Did you look at property? Did you have meetings? Did you meet people for potential partnership? That's what you're referring to, correct?
Right. So the biggest single mistake that people make is they cheat. I mean, and you don't have to cheat. I mean, that's the biggest lesson in tax-free wealth. You don't have to cheat to reduce your taxes. Interestingly, the government's, the IRS is going after high income people because they say, well, the high income people are cheating. I'm going, that's not my experience. My experience is it's the small business person that cheats the most. It's actually, so somebody's cheating when they say, I'll give you a discount if you pay me cash. That way, that's a tax cheat 100% of the time. That's it. Why would they discount it why would they discount it for paying cash? Outside credit card fees, but if
because then they would pay double. They would pay the discount plus the tax when they pay the tax. So obviously they're not going to.
Yeah, right. So why would they do that? So no. So if you see the small business owners, they're the ones, and I think they cheat because I think they don't know the alternative. The great thing about the tax law, particularly in the U.S., we have the Equal Protection Clause of the U.S. Constitution. What that means is, while the rich do make the rules have to apply to everybody. So all we have to do is learn the rules of the rich. And that's what tax-free wealth is about, learning the rules of the rich. Once we learn the rules of the rich, and then we have an advisor who can walk us through the details of those rules and how to apply those on our tax return in our life. Once we have those two things, we can get the same tax benefits that the wealthy get.
Understood. So what are some common tax mistakes that you usually see people make, and how can they stay away from these errors?
Number one is you're a new business owner and you file on Schedule C. You're a sole proprietor. First of all, you're going to pay higher taxes because you're going to pay Social Security taxes on every dollar of your income. Second of all, you've got about a 5 times greater audit risk from the IRS by having a Schedule C. Third, if you take that home office deduction, which is the next mistake that I see people do, they don't take it. Well, they don't take it because some advisor somewhere along the line said, don't take the home office deduction. It's a red flag. Well, it's only a red flag if you have a Schedule C. So don't do the Schedule C and you
And
won't have the red flag.
yeah,
So I think Schedule C is, being a sole proprietor. It's fine to be the only owner, but don't act as a sole proprietor. Set up a limited liability company, be an S corporation or something like that, and or a C corporation, but whatever. The other thing is, I think the other big mistake people make is not getting advice. I mean, if taxes are the single biggest expense of an entrepreneur, single biggest expense are taxes. Why wouldn't you get help? I mean, you're a marketing guy. Why would you not get help with marketing? You want to drive sales, you get help with marketing.
yeah.
Why would you not get help with your single biggest expense? So I think do it yourself. I always say that those are the 3 most expensive words in the English language. So that's actually a huge mistake people make, is just trying to reduce their taxes on their own and not only getting educated, but actually getting some advice.
I hear you. I learned the hard way, I'll tell you. I've always gotten help, but also a big thing, Tom, is you have to find the right help.
Yeah.
Because I'll tell you, look, a few years back, I hired somebody to help me with this, and they made a mistake. Long story short, I got $15,000 fine from the IRS
Oh my heavens.
that they're not letting go. And that was a mistake because you also have to triple check your stuff. You have to trust, but you have to verify. And that's why
Yep.
I like your proposition. I like your offer. I like your content. I looked into your business, like to your CPA firm. I looked into all that because you can't just go to some Joe Schmo down the street and
Right.
expect that they're going to understand maybe how even your business works. Because maybe they work in another industry. So it's also important to not only get help, but get good help and vet it and trust but verify.
Yeah, I agree. And I think trust and verify are really important. You do have to trust people and you do have to verify.
Yeah.
You have to verify. And so, for example, we always offer a free second opinion on your tax return. You go to our website, wealthability.com, you can get a free second opinion. We'll look at your tax return and we'll tell you, did you do anything wrong? Is there anything you do in the future? We do that with our health all the time. Why wouldn't we do it with our biggest expense?
Yeah.
Right. So get another opinion. Yeah, I will tell you, I mean, I've been in this business 40 plus years. I don't know everything. I'm always learning every day. It's what I love about tax is the more you know, the more you realize you don't know.
Yeah.
Here's the key. If somebody tells you something and you don't understand it, they probably don't know what they're talking about.
Yeah. It should be simple enough for them to dumb it down for you.
It should be simple. They need to be able to explain it to you. If you can't understand it, well, here's the second thing. So if you can't understand it, say, okay, I don't quite understand this. Take it to your advisor. If your advisor doesn't understand it, it's probably not your advisor's fault. It's probably because the person trying to promote whatever they're trying to promote, that they don't understand it and that is wrong. I mean, I can't tell you how many times a client will bring me an opportunity and I'll say, great, I'll listen. And I'll be listening to this tax attorney or this insurance agent or somebody like that. And they'll be promoting what I call a gimmick or a scheme. And I'll go, here, well, show me why this works. And they can't. Well, because it doesn't work. Right. But if you can show me why it works, I mean, there's new things every day. Right. So I'm willing to learn new things every day. But really having somebody who can explain it, that's frankly why I wrote Tax Free Wealth, is because nobody had ever explained how the tax law actually works to the general public. And so Tax Free Wealth is not, I mean, a lot of accountants have read it. That's not who it's for. It's really for you and your listeners, everybody who pays taxes. That's who it's for, because the whole idea is let's break it down, make it simple.
Absolutely. Now, for at least a while back, I would be confused. I'm like, okay, bookkeeper, accountant, tax preparer. help me understand, or help the audience understand the difference between these different roles within your industry.
Yeah, thanks. So I actually think the most important person in your financial life is your bookkeeper. Yeah, because if you don't have accurate information, then you're not going to make good decisions. So you need to have a bookkeeper. That bookkeeper honestly should be somebody that's not related to you. It needs to be an independent party and somebody who that's what they do for a living. They do bookkeeping, but it's not very expensive. Bookkeepers are really inexpensive. My bookkeeper charges me less than $1,000 a month for all of them combined.
Wow.
It's just not very much money. So hire it out. Then you have the next person you have is you've got to have your CPA, and your CPA is really doing the analysis, helping you analyze those numbers that the bookkeeper created. And they're also verifying. So they're analyzing and verifying what the bookkeeper does. So when you say trust and verify, you're going to trust your bookkeeper, but then you have a CPA who verifies that, yes, this makes sense. There's nothing that is just, standing out to me that looks patently wrong. Or, frankly, the two people who are most likely to steal from you, Alex, are first your business partner and second your bookkeeper. So you do need to trust, and you do need to verify. And then you have your CPA. Now, ideally, your CPA is your tax advisor, right? I mean, ideally, that's the same person, because the devil's in the details. Your CPA understands your details. They need to understand that that's where there are a lot of tax savings in those details. So we look at, we'll pull a general ledger, which is just all your transactions, right? But we actually ask our clients to do it for their personal lives too, because a lot of times you'll spend money out of your personal checking account that's deductible. Well, if your CPA is tracking all that and doing your tax return and doing your tax advice, then we can actually find that stuff, and we can actually come up with, sometimes I've even found, I've had clients where it's been over $100,000 of additional deductions that I found just by looking at their personal books and going, well, wait a minute, what about this? What about this? What about this? And then the person that is advising you on taxes, I think the most important thing is that you understand that the questions they ask you are more important than the answers they give you. Our job as an advisor, my job as your advisor, is to ask you good questions. That's my job. If it's the same as a doctor, right? You go into a doctor, you have 15 minutes with them, 14 minutes, they're asking you questions, and then they give you a prescription for a minute. Well, that's the same thing with a tax advisor, or a legal advisor for that matter. They should spend their time asking questions. I do have, you probably noticed in chapter 23 of Tax Free Wealth, a whole chapter on how to find a good tax advisor. So, there are really specific things that you look for in a good tax advisor.
And I'm guessing, you did mention these different positions, but there are businesses, a lot of instances also, where you may have to work with a tax attorney of your client, or for example, asset protection attorney.
Yep.
Is that something that's common within your client base?
Oh, for sure. So one of the things that we've discovered over the years is that we're very effective at building teams, and business investing, they're team sports. Right. So you've got to have not just one attorney. Attorneys are specialists. So you need an asset protection attorney. You, as a business owner, you probably need an intellectual property attorney. Mm-hmm. You may need a general business. You probably need a general business attorney, a contract attorney. You get into any kind of trouble, you need a litigator. If you get into tax trouble, you need a tax attorney, right? That's what tax attorneys are for. Therefore, once you get into trouble, CPAs are for keeping you out of trouble, and tax attorneys are for what happens when you get into trouble. They're the ones to get you out of something you got into already. But yes, I mean, you need insurance agents, you need bankers, you need, you're going to need somebody to help you. What do you do with your money? So there's a whole team of people that you need. And that's actually one of the things that we do is we help people, our clients, put those teams together, because by nature as CPAs, we know everybody, right? Yeah. We're already always dealing with the insurance agents and the bankers and the lawyers. So we know those people, we have conversations with them. The other thing I want to say, Alex, is that a lot of times your team members don't talk to each other. So, and this is a huge mistake. So your asset protection attorney doesn't talk to your accountant, or your accountant doesn't talk to your bookkeeper, or your accountant doesn't talk to your insurance agent. It's very important to have those lines of communications opened, because otherwise what happens is the attorney blames the accountant blames the attorney, and the person who loses is you.
Yeah. You're absolutely right. And I'm smiling because I feel like there's so much value in what you're sharing here. And from my experience, like what you're telling me is like, yes, like these things are necessary. People need to speak to each other, not people blame each other. They point fingers, things get lost in translation, telephone. This has been value packed. So Tom, listen, there's a lot of myths out there. Can you tell us one big tax myth, and how does believing in this myth change the way people handle their money?
Boy, there's so many of them. Let me start with the rich don't pay taxes because they cheat. I think that's actually a very, it's not just bad for society that people believe that, obviously, because then people don't trust the tax system, but it's bad for the people who are saying it. Because if you believe that they're cheating, then what it does is it like says, well, then I can cheat. And the issue there is you can, if you cheat, here's the problem. If you cheat, you have to be perfect at it, right? You can't make one mistake because you end up in prison, right?
Yeah.
Whereas if you do it the right way, if you do it legally, ethically, and morally, and you don't have to cheat. I mean, I have plenty of clients who pay, let me put it this way. My clients pay as little tax as they want to pay. Now, they don't always want to pay zero because sometimes the juice isn't worth the squeeze, if you will. But our goal is to get, our first goal is to get people down to a 20% tax rate. That is our first goal. And we're very successful with that. Then if they want to go below that, you want to get to zero, great. We'll show you how to get to zero. Again, you have to do certain things in order to get there. It's not some magic pill that you take, that you do actually have to take action. I think the other, I'll tell you another big myth is that people say, well, my CPA handles that. I don't have to worry about taxes. My CPA handles that. Well, that's a myth. Your CPA can't reduce your taxes. I can't reduce your taxes. I can tell you what you need to do to reduce your taxes, but I can't actually reduce your taxes. Okay. The third myth that I really want to dispel is, and this came up, I was in a mastermind group of very successful entrepreneurs the other day. And I was in this small breakout group, and I was telling them about tax-free wealth. They were new to it. And they were shocked when I said, we typically can show an entrepreneur how to reduce their taxes by 10 to 40% in 3 months or less. And I go, well, the first question was, well, what are you using? Is that like insurance, or is that some scheme that you're using? I'm going, no, you just have to understand how the tax law works. So I think that's a big myth. People think, well, if the rich are getting away from, if the rich aren't paying taxes, for example, it's because they're using some exotic scheme or some exotic mechanism or some exotic investment to do it. And the answer is no. You don't buy into that stuff. That is, most of those things don't work. And the IRS goes after them. I can't tell you how many. The IRS went after 3 or 4 of them just last year that I'd heard about for the last 5 years. So the IRS will catch up to
yeah,
those.
They're slow, but they'll find you. Yeah.
It's like the deferred sales trust. That's been the most recent one. And people kept asking me, do you know what a deferred sales trust is? And I said, yeah. I said, doesn't work, but yeah, I know what it is. But I've gone through all, of course I research all this and I do all the hard legwork on it. And I'm open to it until I go, yeah, I don't think this works. And sure enough, the IRS goes after it, and they rightfully are going after that one. There's some things they go after that they shouldn't be. But that one they should be going after. And so you don't need exotic. You don't need anything exotic. You can reduce your taxes. Think of it this way, Alex. Every dollar you bring in is either taxable or not, and every dollar you spend is either deductible or not. So if you want to pay zero tax, just keep that in mind with every dollar you bring in. How do I make the dollars I bring in less taxable? And how do I make the dollars that go out more deductible?
You've dropped some serious quotes, like one-liners on this podcast, crazy that are sticking. And I know they're going to be cool for us to share with everybody. Thank you, Tom. Well, look, you share ways to use tax loss to make more money. Can you give us an example that might surprise our listeners of how you can make money in this way?
Yeah, let me give you one that people don't often think about. Let's say that you go on and you've got an office building because you're not just marketing online, but you're marketing. You have staff, you have people that actually want to be in an office, and you have an office building. Going, okay, well, you're probably paying utilities on that office building. Well, what if you put solar panels on top of that office building? Now, you probably can't put them on your parking because it's probably not strong enough to hold the solar panels, but you can put them on your roof of your building. And here's what happens. So not only do you get 30% credit immediately back on your taxes. So that means if you put $100,000 on your building, you get $30,000 back from the government. On top of that, you get a giant deduction called bonus depreciation. In 2023, it was about 2/3 of the cost of the solar panels that you got to deduct. So effectively, you're paying less than 50% of the cost yourself, and the government's paying the other 50%.
Wow.
The government is literally paying you to make that investment, and your utility bills, go away for the next, or they go way down, particularly if you're someplace like I am, like Arizona, and your utility bills go way down. We actually calculated on our solar panels, our return on investment's about 22% because we didn't put most of the money in, the government did. So it's so simple, but people don't hear about it. People don't know about it. They go, well, I can put it on my home, but I only get a 30% credit. Yeah, because it's on your home. But by the way, if you were buying an investment property and put the solar on the investment property, you'd get an additional 30% in tax benefit from the deductions. So here's another thing I always tell people. The tax law is set up so that if you do things for yourself, you may get some tax benefit, but if you're more generous and you do things for other people, you get a lot more tax benefit. So if you build housing for other people, you get deducted 100% of your interest in taxes if you build it for somebody else, but you're limited if you do it for yourself. You get twice the solar tax benefit if you do it for somebody else or put it on a building that somebody else is using or your business is using than you do if you put it on your own home. So people don't really think about the tax laws encouraging people to be generous. But really all of the ways to save the most taxes are really based on what are you going to do with your money? And the question that, I hear a lot of people talking right now, tax is actually pretty popular. I like to think I helped popularize it, but people are talking about, okay, well, so you can do, these little things. I talk about all of them in tax-free wealth. But then the next question is, what are you going to do with your money? Because what you do with your money has a much bigger impact on how much tax you pay than how you make your money, which has a big enough impact. But I'll tell you the other surprising thing, I think that people always hear that, there are certain things that you just can't do. I learned the hard way, and if you don't mind, I'll share a quick story. I actually learned in a really interesting way that that's not true. I was in Santiago, Chile with Robert Kiyosaki a few years ago. And the sponsor of the event, we had about 600 people in the room. And we had a Bentley on one side and a Lamborghini on the other side of the stage. And Robert says to me first thing in the morning, he goes, I want you to tell him how to deduct a Bentley. So I get up there and I give him the rules in the US for deducting a Bentley. At noon, this tax attorney comes up to me. He says, just want you to know, you can't do that in Chile. I said, okay. So later that night, I'm telling Robert the story and the other speakers the story. And Robert just looks at me and goes, next morning, because it's a 2-day event. Next morning, we're about to get on stage. And he goes, Tom, today you're going to tell them how to legally deduct a Bentley in Chile. I'm going, I had no reason to doubt this guy this tax attorney who just told me you can't deduct them. But I said, okay, we'll figure that out. And sure enough, later that day, Robert and I are on stage and we actually showed how to legally deduct the cost of a Bentley in Chile.
And he checked off on it.
And the tax attorney comes up to me at the end of the event. He goes, Tom, I never would have thought of it doing it that way, and it would absolutely work. So my point is that, I used to say there are just certain things that aren't deductible. I don't say that anymore because I learned my lesson that there's always a way to do what you want to do. And as entrepreneurs, what we want to be told is not what we can't do, but how to do what we want to do. And that's really, that's really the message of tax-free wealth.
So for our listeners who are just starting to learn from your book, what's the number one thing you want them to know about understanding their taxes better?
Well, first of all, that, there's over 6,000 pages of tax law. And there's one line that says all income's deductible. All income's taxable unless we say it isn't. And there's another line that says nothing's deductible unless we say it is. And then the rest of it is literally a roadmap to reducing your taxes. So that's actually the big thing. The other thing that I think, by the way, I want to catch another myth that people have, and that is that if I earn more income, I go into a higher tax bracket. And so they're hesitant to get the bonus, the raise, or pick up income at the end of the year from our client. It only pushes a small amount into that higher bracket, not all of your income. I used to do a class on a 3-day class, and I did this example, and I'd always ask, so you get a $5,000 bonus and, this is how much you're making. What's your additional tax? And I'd get people say, well, they'd calculate it and say, well, it's $8,000 because they assumed that $5,000 pushed all their income to a higher bracket. No, the $5,000 it's only the top income that's in the highest bracket. But here's kind of the flip side of that. So the last dollar you earn is taxed at your highest rate, but the first dollar you deduct is deducted at your highest rate. So what that means is that the reason that a 401k actually works is because even if let's say you're making $200,000 a year, your whole life, and you put $20,000 a year into your 401k, you go, well, wait a minute, I'm going to pull the $200,000 out, hopefully, when I retire, right? I don't want to retire poor. So I pull that $200,000 out. Aren't I taxed at the same rate? Did I really gain anything? And the answer is yes, you did. Because that $20,000 you put in was deducted at the highest rate, but you have a whole set of tax brackets when you pull it out. So you literally actually pay less tax. And I had to eat my words on that. When I wrote the Win-Win Wealth Strategy, I did a chapter on it. The last chapter of the book, chapter 8. And I said, I actually did the math. I'm going, hey, it actually does reduce your taxes if you want to invest, if that's what you want to invest in.
That's
but
what
again,
you're.
Yeah. But again, the other issue that I would tell people is, don't let the tax tail wag the investment dog. So in other words, don't do something for tax purposes. Do taxes, make sure taxes are part of the equation, but don't be investing in something because it reduces your taxes. You invest in it because you want to invest in it, and it's a good investment.
Believe in it, you understand it, yeah.
And the taxes just increase your rate of return. They don't cause your rate of return.
Okay, so listen, we have a question for you from somebody in our community. His name is Zach Tavener. He says, hey, Alex, a question for Tom. Would love to hear his thoughts and on QR reps and how it can be used to offset taxes with real estate on personal/business income. Let me know if you want me to reread that.
Yeah. What does he mean by QR reps?
That's interesting. He says, hey, Alex, a question for Tom. Would love to hear his thoughts on QR reps and how it can be used to offset taxes with real estate on personal/business income. Doesn't sound too clear, huh?
I wonder if he's talking about QRPs, which is a qualified retirement plan.
Okay.
So let's start with that one. Okay. So general rule is don't be buying real estate in a retirement plan. It's a bad idea. The reason is because real estate's really, when it comes to which are the best investments from a from a tax standpoint, real estate's number one after business. Business number one, real estate's number two. And so a qualified plan, so qualified retirement plan, a QRP, a qualified plan is really like a 401k plan or an IRA. Well, not an IRA. That's actually a different kind of plan, but a 401k or a pension plan or profit sharing plan, those are all qualified retirement plans. Well, what all that does is postpone my tax. But what it means is I'm still going to pay tax on that real estate, on those real estate investments at some point in the future. But if you invest outside of your qualified retirement plan, you should never be paying tax on your real estate, ever. Period. I mean, you should have permanent tax benefits forever and ever if you do it the right way. So, I don't like investing in real estate. There are a few times when it probably makes sense, but for the most part, I would not do that. So I just don't like it. I think it's a bad tax plan.
Thanks for sharing, Tom. And hopefully that answers Zach's question. I know he's a reader, and he was excited to get the question over to you. And last question for go ahead.
Well, so I was going to say the other thing that he might be talking about is a real estate professional. So that's REP. So there's acronyms. The other thing I hate is I honestly, I don't like it when I hear tax professionals use acronyms, because what they're trying to do is make something sound fancy when it isn't. Like a QRP. I've heard people use QRP in their marketing. I'm going, that's been around since 1974. It's a qualified retirement plan. It's not magic. But a real estate professional, if you're a real estate professional, it's kind of a get out of jail free card in that you get to take all of your deductions like depreciation and everything without limitation. Well, there's one small limitation, but pretty much without limitation. And so real estate professional, and that can either be you or your spouse, that your primary business is real estate, that can be hugely beneficial. So in case that was his question, I'll answer that one too.
Beautiful. Thanks for being thorough. So last question for you, Tom, is how do you want to be remembered?
Oh, so I actually want to be remembered as a great dad and grandfather. So that's the number one. I have two grandkids. They're the light of my life, and I have two sons and two stepchildren, and they're my life. So that would be the most important thing. Professionally, I would like to be remembered as just a great simplifier, to simplify really difficult topics, but that would be professional. I just want people, we have a mission at our company, Wealthability, and the mission is we believe that everyone has the right and should be able to be financially free from government, employers, and Wall Street.
Yeah. Okay. Where can we find you on socials? And after you tell us where we could find you on socials, where can we find your business if anybody wants to hire your services?
So, believe it or not, Alex, I'm on TikTok, I Instagram, YouTube. I do a lot of YouTube, and I have a podcast, The Wealthability Show. So if you look up Tom Wheelwright, I'm everywhere on social media. I have a great team. It's not me. I'm a baby boomer, so it's not me. It's my amazing team that gets me out on social media, and I love it. I love the social media. I actually love TikTok because it makes you take a very complex topic and distill it down to 30 seconds.
Yeah.
And to me, it really helps me with my simplifying skill for sure.
Yeah, your delivery, of course.
Yeah. So to find us, just go to wealthability.com. It's just like it sounds, Wealthability. We are about helping you increase your ability to create your own wealth. So it's wealthability.com, and just click on a consultation, and we'll do that second opinion for you on your tax return.
Beautiful. All righty. You heard it, y'all. This is Alex Quin, Tom Wheelwright, author of Tax-Free Wealth, Win-Win Wealth Strategy. And all around excellent entrepreneur. I've been seeing his content on social media for years. So for me, it's an absolute honor to have him on the podcast. And for you, if you want to learn more about what we talked about today, everything that was mentioned, you could find it on the show notes of the episode of whatever platform you're listening on. Just go on the description. You'll be able to find all the links. If not, you could go to hustleinspireshustle.com/podcast, and you will be able to find our episode by searching his name. Thank you so much, everybody, and we'll see you on the next episode.